Okay, welcome everyone on the Sunday morning as we'll continue our discussion on the annuity topic of annuity that is going on for last 2, 3 weeks. And I know this is one of the most demanded topic, most sometimes it's really complicated also to understand different products, how they work. Lot of things, lot of moving parts in this annuities, right? Lot of confusions also. So we still want to take it easy and maybe spend more time on it, a couple of weeks more. So, and it's good that you are asking questions. It would be helpful if you post these questions after the meeting in your WhatsApp groups also or before the meeting so that we can have a better, coverage of these questions also. Like what was asking, like comparative between different products, their rates and all. It would be very, very easy, right? And when you ask questions, then you also think through it. So keep asking questions. It will benefit others also. Now, let me share my screen and quickly go over some of these things again today. So I always like to refresh what we already read, right? So just quick refresher of maybe 2, 3 minutes for some of the folks who are pretty new, who missed out few sessions in the past. So this is just a simple thing which I got from ChatGPT. There are so many easy ways now to learn. So I just typed in the question, what are annuities? And I got everything out of it. Let me read through it and it will really make a lot of sense. And I can share this document if anyone needs. So what are annuities? Annuities are financial products sold by insurance companies. Now, this is one of the confusion that a lot of people have, that annuities can bank offer, can other offers, they are sold by insurance companies only. And what are the purpose? That are designed to provide a steady income stream, typically for retirement. Right? You can think of as a way to turn a lump sum money into guaranteed payment over time, just like pension, right? So as simple as that, issued by insurance companies for guaranteed income. Now, what are the key features? You pay in lump sum money. Most of the time you pay lump sum, but there are some products where you can deposit on a frequent basis, like series of payments. Then you get paid out either starting immediately, which is the immediate annuities, or at a future date, which is deferred annuities, and often monthly for life or static period. So you can set monthly, annually, but or a specific period or for life also, as I just mentioned here. And what are they? They are contracts between you and the insurance companies. So that's a very basic definition. If someone asks you what is annuity, how it works, this is what you can tell them. Now, how do you differentiate between different types of annuities? So there are three ways that you can differentiate. First one is based on the payout timing. And this is the most important one, right? The difference. Like some people are looking for income immediately. Those are called immediate annuities. It starts paying out right away, usually within a year, like within next month. You start today, and from next month, you start getting a check. And that is also for life, or some specific amount of time. So, we can definitely help client with immediate annuities. We have some products for that. But 90% of our clientele, which I have seen, looking for deferred annuity, which is payment begin at a future date, so that it allow your money to grow, right? So you start a rollover of your funds today, and as we discussed, right, at 40, 45, 50, in an expectation to start income once you retire after 59 and a half, 60, 65, because these are all qualified plans. So it is always recommended to start income after 59 and a half so that you don't have, or you will not be subjected to the IRS 10% penalty, right? The other way to differentiate between annuities is based on the investment style. Some are fixed annuities, just like CDs. They pay a guaranteed rate of return or a fixed interest. Variable annuities are more like stocks, which can go up and down based on what indexes you are picking. And then the index annuity, which is basically, again, it grows, but it always have some kind of a cap, participation, or a spread. but it has a bottom. It has a floor of 0%. So you will never lose money, right? So now these are another way. Can we do all? We can do fixed and index. We don't offer variable annuities. It requires a different license, securities license also. So we don't do this. And third one is mostly based on the duration of payout, lifetime income annuity or period certain, which pays for number of years. So there are quickly, a couple of ways to distinguish between different type of annuities. And if you see in overall spectrum, we definitely offer 90% of the things that people are looking. Now, why someone wants to buy an annuity? Because for retirement income that you can't outlive, as long as you live, you will receive the check, and it has the same tax deferred growth for deferred annuities, estate planning or passing monies to beneficiary, because annuities are not subjected to, the probate and the lawsuits and all. So it's a good way to secure your money also. And protection from market loss in fixed and index annuities. Again, as I said, right, this is one of the reasons why a lot of people are looking. I'll show you one survey that why exactly this is happening. Now there, like everything has, plus and minuses. So what are some disadvantage, or I would not say disadvantage, or downside of looking at annuity? There is a fees, especially with variable annuities, which are expensive. So luckily we don't do variable. So we don't really deal with the fees. This is one of the major objection that you, like when your client is going to a financial advisor. So he's talking to you, and at the same time he's talking to an advisor. The very first thing that advisor tells them to your client is that, oh, annuities are very costly. The fees is very high. Now you are struggling to find out, why they are saying that, where the fees is. But usually it's with the variable products. So other fees that you will see in the products that we offer is mostly the rider charges. Those are optional. If you are planning to buy a rider for getting an additional benefit out of something, then you pay that fees. It's not mandatory. Most of the products are zero fees. Okay. Then surrender charges. Yes, there will be surrender charges for any product that you pick, pretty much, which is basically penalties for withdrawing early. Now, how it is a downside, because you are locking in your money for a certain number of years before you can move out of it. 7 year, 5 year, 10 year, whatever that surrender period is. Now, why it won't be really a big downside is because what we are doing is mostly rollovers from other qualified accounts. For that, client is already logged in till 15 and a half, right? They're not planning to take out money before that. Otherwise, they will anyways pay penalty to IRS also. So if that's the case, I know for sure, one second, that I know for sure that they are going to stay in this plan for 10, 15 years. So this can also be countered very easily. Yes, this surrender and liquidity, illiquidity is pretty much same thing, because you are not withdrawing money early. You cannot take it out. Especially if it's an income product, then this money is in the plan forever, pretty much. You are not looking to withdraw all of it again, right? So how do we answer that? That we'll see in the presentation. And then taxation, earning her tax. I don't see it's a downside. It's because it is true with any investment that you do, whether it is in 401k, IRA, anyways, you have to pay tax there also. So if you see, there are not really many downsides of getting into annuity. You just need to see how it will help your portfolio, where it will fit you, right, in this whole spectrum. Now, as I said, there's a huge demand for this. Why? I was just reading, so let me share this. So this is the very recent article from LIMRA. This is one of the most recognized third-party agency that reports on all these financial products. And it just came out like few days ago on June 17th, right? and more than half of the 20 annuity carrier reported sales growth. So basically, they are based on the top companies and their performance for the last quarter, first quarter of 2025. And what they say is total US annuity sales were $106 billion in the just first quarter. And it's a billion with a B. It's not a small number. In just 3 months, the industry is doing $106 billion just annuities. I'm not talking about stocks or any IUS or any other product, just the annuity, right? It level with the record set in the first quarter of 2024. And if you go back and look at the 2024, there was a growth of almost 23% of that number. So still it is growing at the same pace because it's keeping the same number year over year, according to results from Limra Sales Survey, right? The quarterly survey represents 85%. So it's basically on a very big segment of the market that they are giving this number. So we know the market is growing. We know the market is growing very, very fast. There is a huge demand now. Why that is so? So total annuity sales top 100 billion for the sixth straight quarter. 6 straight quarters, it is crossing $100 billion. Now that it's not just it is happening just once or twice. This is a pattern that people are seeing. A lot of people are coming out of their equity portfolio, especially their IRA 401k. Not all of it diversifying good bit of money. Why? Because it's a growing interest in principal protection and guaranteed income continues. Now, exactly what we are talking from last 2, 3 weeks, there is a big change in the paradigm of people, the way they're investing. A lot of people are not willing to take market risk. They want principal protection. They want guaranteed income. That's exactly what we are offering. And that's too many consumers. And another very important point, why you and me are so important at this point of time, holding a license in this industry, because too many consumers and advisors don't know enough about annuities and how they can help Americans achieve their financial security in retirement. This is exactly what we are talking about in so many trainings. And this is why you feel surprised when the moment you say somebody, hey, let's talk about annuities. And they say, what it is? How do you spell it? And trust me, before starting this business, when I started here, I heard the word annuity first time. I did not even know how it is spelled out. And you see the market has totally shifted. Now it is up to you whether you want to educate your clients and consumers and friends and family and help them with these solutions, which anyways they're going to get, whether you talk or not, because the way the things are spreading, the way now a lot of financial advisory company also getting into that. They are asking their advisors to get insurance license and start pitching that. Trust me on that, within 2, 3 years, you will see most of these companies will add annuities to their portfolio. There's a big discussion going on for the 401k plans also to add annuities as one of the investment option into their 401k plan. So if all that is happening, then what are we waiting for? We can add tremendous amount of value to our client's portfolio if we start doing this. Now another thing is, I don't know whether the companies that we have will work or not. So here's a shocker, another shocker for you. I showed you last time 2023. This is 2024. The ranking that came out recently. They released the ranking in the month of April, right? So it just came out. Now, if you see, out of 20 companies, top 10 in the fixed market, we have Athene, we have Corebridge, we have North American, which is Salmons Group, we have Allianz, we have FNG, we have Nationwide, American Equity. In top 10, we have 6 or 7 companies that offers the product. Now, what is there to worry about, right? It just requires our education. First, get educated and then talk. We know the market is growing. We know the consumers are not aware of these things. But as they learn, they are participating in because market is consistently growing. We have all these companies with us. I'm telling you guys, this is a big, big market. If you just do this, trust me, you are earning six-figure part-time income just by talking about this. And there is nothing required, no medical, no labs, no health condition. All they need is let's diversify some of your portfolio. I'm not even asking them to, roll over all the money, just 10%, 20% of their portfolio, right? That will help them. So I hope you are taking, if anyone needs these links and all, just, post in the WhatsApp group. I will be happy to share all those things. But now let's jump into one of our products or one of our provider, and which is the number one in the retirement industry. Working with number one carrier, you feel proud about it. Hey, I'm offering the best of the best products. And trust me, you go to the convention, it's happening next month. You see Athene with their senior management there. Go talk to them, get their numbers, and take some pictures with them, right? With their like Larry and other person, their top people, and have it on your phone. When you talk to clients, show it, hey, I work very closely with Athene. You see this person? He's the senior VP of the product sales. He's this person. Let me talk to him also about your case and see how we can help you. Hey, when you talk about that, you say, oh man, this guy is knowing the senior person of this top companies in this industry and willing to help me and willing to talk about my portfolio with this person. You know what kind of credibility it builds? But for that, you have to spend a little bit of money, maybe $1,000 or so. Go attend the convention. Maybe you have to take a day or two off, but it is worth it. Trust me. It's still a lot of time. Register for convention, go and attend it. Meet this provider in person. You will see their Corbett. You will see their North American, Allianz, Nationwide, all of them, FNG. They all will be there with the senior management, not just some salespeople. Take pictures with them. Use them as a pitch. Okay, so let's dive into Athene. Last week, Venkat did on Nationwide, which is amazing presentation. A lot of doubts were cleared. You still will have a lot of doubts, so keep asking those. Don't talk to your clients until everything is clear. Use your field builder for these purpose. Okay, so once you're licensed, you get access to the portal. Before that, you just see their public site. But let's say you're licensed, so I'm going to log in with my license. And when you log in, you have all the things here. But let's look at the product. So in product, and they have a lot of tools for retirement strategy, growth. There are so many things. Maybe we'll talk one day on the resources available. But let's look at some of the products. So as we were discussing in our initial product annuity overview, right? There are different products. So some are growth product. This is max rate is the CD-like product, fixed product. Agility is income product. Ascent Pro is income product. So there are different variation that they offer. BCA growth product, right? So as Abhijit was asking, right? How do I know which one is right? It takes some time to prepare this chart and to find out what exactly the bonus, what exactly and they keep changing. So it will take a little bit of effort. But I think once you are experienced enough that then you know top of your head what product is what. All you need to know is what is the current offering. And usually these companies are very good at communicating this, keep sending this, emails that these are the changes that they are doing. So look for that. But we'll definitely come up with more compilation of that thing. Okay, so since we were talking about the income product last time, so let's continue so that it will help you to compare between Nationwide and Agility, right? Now, everyone who is licensed, don't just directly jump into the illustration. You see, there are so many things available here. There are brochures, there are rates, there are payout chart, and some of the use cases studies. So let me show you one simple brochure first. And these are client-facing brochure. You can share with them. Why it is a good idea to share with them? Because it has a lot of information that they want to know. Because a lot of people don't even know what Athene is. When you say, let me run some numbers, Athene, I never heard of it. Nationwide, because they do a lot of publicity on, on TV and other ads, because of their other market also. People do know about them, but Athene, not many people, right? So you can talk about Athene a little bit, that what this company is, financial strength and rating. You see all this A plus, A plus, A plus, A1 with the recent updated rating. That's what client wants to know. That they are working with a company which is number one, at the same time very high financial strength. Superb rating. That's their financial standing. All this billions of dollars sitting in assets and all. I don't expect you to understand all these gap assets. If you know, that's great. If you have accounting background, you can easily say general accounting asset purpose, something like that. General assets for accounting purpose, right? And for liabilities and all. So these are very big numbers. These are very, very big numbers. These are good numbers. So share with your clients. Other thing that they feel comfortable is that Athene is not, it's a part of Apollo. Athene strategic partner Apollo, which is a very big asset management company. And if you see, they are publicly traded. Both of them are publicly traded. So you can look at that. So all this is a very, very good information. Athene is a subsidiary of Apollo Group Global Management, right? So, and now some of the people might heard about Apollo. So that will give them like I had a doctor client who said, Athene, oh, it's from Apollo. Oh, yeah, I know. I bought some Apollo shares and it's doing very good. So he was talking about all this thing. So it's a very good information. You can share. It's very, professionally done. Looks very nice. Then it tells about what retirement plans are, not more people have proper plans like 72 percentage. So all those things. And then some product related stuff. You can rely on the growth that is protected, guaranteed paycheck. See, this guaranteed retirement paycheck, they are giving that in writing. It's a guaranteed retirement paycheck. People love to see this word, guaranteed. And in their retirement, no one wants to take chance. They want guarantees. So all those things are here. Uh, let's see what other thing I can share from here. I want you to read this thing because this is very, very build a benefit base that prepares you for future. Initial benefit base includes a bonus. So exactly what these plans offer, right? The benefit base, what Devang is asked, what is the difference between the growth plan and these plan income plan? Because they all work on a benefit base. So your benefit base gets a bonus, it gets a you know better rate of return also. So we'll look at that. And how it grows is benefit based bonus with interest credit minus the withdrawal. So we'll like look that in the chart in the illustration very soon. Uh, an income and death benefit rider is included automatically at no additional charge. So this is one of the strong distinguisher between Athene and Nationwide. One of the major difference. And I'll show you that why that is so. And then 200 interest credit, we'll talk about that also in a second. And all these other product features that we'll see. So that's all good. So I'll want you to download this brochure. If you're not licensed, you still want to read it, just send me a message, I'll send it to you. And then also read about this thing. This the rate and availability charge. So these are two flavors of this product, Agility 7 and Agility 10. The difference is like Nationwide has 8, 9, 10, 12. The difference is the surrender period. This is locked in for 7 years. This is locked in for 10 years. Before that, you will be subjected to surrender. Now, 10 years will always have the higher bonus because company knows that you will be staying at least for 10 years. and 7 years will have a little bit less bonus. So let's look at the 10. You can look at any also, right? So what this shows, rate chart shows you is what are the index crediting or index available. So it shows all these 2 year indexes that are there, what are their current participation rates, all those are there. 1 year indexes, and for S&P also how much the cap is, right? If they are offering any fixed strategy, then the fixed basically 3.2, and for California it's 3%. Okay, so this is fixed if somebody wants. Now, this is another common question, like, can I offer to this client? Somebody asked me about a client who is 35-year-old. The issue age is 40. So you cannot offer this product for people who are under 40. They have to be 40 at the time of signing this application, right? So until 80. So you cannot offer people who are over 80 also. Okay, now this is important to know. Other important thing to know is what is the minimum contribution to start this. So in most of the states it's 10,000. Some state offers it 5,000 also, right? Maximum, it's pretty high number. $1 million is always there. But if you have a client who is interested in even more money, we can discuss with the client and they will be more than willing to work and issue with the higher also. Then we see the schedule for withdrawals and surrender, right? Free withdrawals, terminal waivers, all these are good riders that are in there with a plan. What I was looking for is, this thing. Benefit-based bonus, 50%. So this number changes, like it used to be 35%, then 40, then 50, because they also want to compete with the market. Like Nationwide from start with 20, they did 30. So just like the other competition, right? These companies also keep competing with each other to get a better market hold. So right now it's offering 50% bonus and the interest credited at 200%. Right? Now, one of the major difference between Nationwide and Athene is right here. The first thing is the bonus. There you have 30% bonus, here you have 50% bonus. Nationwide doesn't offer anything like a better interest crediting. Like in Athene, you get 200%, which means if your index perform, let's say 5%, then they double it because of 200%. So you get 10%. If your index perform 10%, you get 20%. And that will be added to the benefit base. So I'll show you that also in the chart. But in Nationwide, you don't have that thing. But what they do is they give you 9.5% guaranteed return for 12 years. Athene does not offer that. Athene says one time we'll give you 50%, but from the interest crediting purpose, we'll look at the actual performance of the index, multiply it by 200. So if it is 0, then you only get 0. If it is 1%, you get 2%, right? So it depends on the market performance. Now, some people are fine with that. But here, you get higher bonus, but you are depending on the market. But somebody who's really interested in a guaranteed income and doesn't want to take any chance with the market, and they're happy with 9.5%, then they like that one. Now, if you ask us which one is better, I don't know. It depending on totally on the client, right? So which one they want, what suits to their needs better. Okay, so another distinguished feature is income waiting period. In Agility 10, client have to wait for 10 years. They cannot turn on the income earlier. One of the requirement is age 50. A second requirement is it has to be at least 10 years before they can start. In Nationwide, 50 is there, but you can start income after 1 year also. So that is a flexibility that they have. It's not required to start after 1 year, but you have the flexibility. Here, even if you want to start after 1 year, 2 year, 5 year, you cannot. You have to wait for 10 years, right? So these are some of the major features that people love to see, right? And where and all we can offer this product pretty much everywhere except New York. So for some reason, New York is one of the states where not many insurance companies wants to work because of some regulations or things like that. So it is hard to find product in New York State. Okay. So we have, I think, from Cold Reach couple of products, and Athene offer the guaranteed product like the CD product, Max. Okay. So this is on the chart. Now, other thing that you can see is this is one of the important rider, no rider. Now this again, not many people are aware of this thing also, that 9 out of 10 fixed index annuity have income rider. Income with a rider charge, like Nationwide charges 1.1% for that. Athene does not charge you anything for the income rider. It's inbuilt into the plan. Right? The death benefit rider and the income rider both are inbuilt. Now, how it will differentiate? So this is a simple scenario which says if you start with 100,000, let's say you have 100,000 and earning 3% interest credit, just to keep it very simple, right? You started with 100,000, 3% credits, and you are paying 1% charge, the rider charge. So this is with rider, and on the right side, no rider. So first year from your 100,000, first they will subtract the rider charge. So you are end up with $99,000. So 99,000, you earn 3% interest, so that is 2,970 minus $1,000 for the rider charges that you already paid. So you end up making 1,970 on this. Whereas if there are no rider charges and you grow 3%, it's all added here. So how much additional you made? 1,030. So if you continue to see, once your account value is high, this number, the difference also goes higher and higher. Again, is it a bad thing or good thing? I don't know. Because if client really wants a 9.5% income growth, they are willing to pay this charge. And this is on the accumulated value, not on your income value. So if your idea is just about income, I don't care, I never want to walk away with my money, then you don't care for this charge. Better it be 3%, 4%. I don't care because I'm not interested in withdrawing my money at all. All I'm caring is a better and higher guaranteed income for myself. That's when you can always go there. But if it says, no, I don't want to pay any rider fees, maybe I will walk away with my money. What is that? Then look at this. So I hope it is making some difference. It is making a little clear, you know. And again, everything is here. I haven't created even a single presentation. All of those things are here. There's a use case study also. Somebody who is age 55 and get this plan, different life scenarios, right? Starting income, getting into a sickness, and then passing away. How the account will work, how the money will be distributed to the beneficiaries or to her. All these are nicely demonstrated in this illustration here. So, spend some time on this. It's very hard to explain everything in this call. Otherwise, we have to do like a full day session for this. So, but a lot of these resources are available here. Now, we still have 10, 15 minutes. I might go a little bit over 10 minutes, maybe 5 minutes, but I really wanted to cover at least one product. So now let's jump into an illustration. So run an illustration, go to the illustration center, and pick the product. So I want to show Athene, and I have a valued client who is, let's say, age 50. and say, okay. And it can be a 40 year, it can be 50 year. And usually I do qualified money. So let's say qualified, right? Simple as that. Now let's look at the policy details. So if I know that client is not looking for income in 10 years, I will discuss both the scenarios, but mostly it's a good idea to provide them higher bonus and all. And they are coming up with this 100,000. There are multiple other options that they have a desired income level that they want or desired level of accumulation. So you can, it's more like a reverse engineer that. But let's say most of the time they say, what if I do 100,000? What will I get, right? You can play with actual performance, average performance, right? And now here are some options, the indexes that you can pick from. 2 year and 1 year, right? 2 year means the amount will be credited in their account after every 2 years, right? So in between 2 years, the account or the index can go up, down, up, down. It doesn't matter. They will look at the initial point and the ending point, and then they convert into the percentage and credit. So sometime, fortunately, client started at a very low, but by the time their anniversary comes, the market is really high and they get very good credit. And sometimes they waited for all 2 years. Market was very high in between, but for some reason, by the time their anniversary comes, market again dropped and maybe went negative, and they end up getting zero or a very less. So now, how do you find the right thing? There is no magic thing, no magic formula for that. It's just that it's a better idea to diversify. Share this thing with client, ask them what are they comfortable with, and then diversify. If you have no idea, just put 25% in most of them, right? So let's say if I do this, let's say put 25, 25, and in S&P also put 25. And what else we can do? This balance. Yeah, I think that's good. I can do Nasdaq, I can do 50. Okay, just randomly picking something, right? But you can always look at some past performances and check that. Again, when you are working with a client, before you submit application, make sure you type your agent code with Athene here and check whether you are eligible to sell this, because there are some training requirements that you have to complete before you can submit application. Okay, now some of the riders, again, they are also offering single and joint both type of income. Joint means that if you and your wife both are part of the joint plan, then whoever lives longer will continue to have income. Same amount of income the surviving spouse will also receive. So this is a very good way to have, peace of mind that, if something happens to me, my wife or my husband still have the same income. They don't have to worry about this money. It costs you 0.5% less in Athene, but still it's a very, very good way to plan. Now, another different or differentiator between Nationwide and Athene in terms of income withdrawal is that in Nationwide, you have to decide it at the time of the application, whether you want a joint income or single income. You cannot change that later on. In Athene, they allow you to make that decision before you start the income. So you can submit your application with single or joint, but after 5, 10, after 10, 15 years, when you actually decide to take the income, you can tell the company when you fill out the form, you can say, are you interested in a joint or single? So I like that flexibility because I don't know at this point of time what those growth will be, what my numbers will look like. So what if I keep that way, right? So again, you can do that. Now, in the withdrawal section, they show you, because a lot of these are for retirement products, right? Retirement plans. So people are worried about their RMDs, required minimum distribution. Once they turn 73, they have to withdraw a certain amount of money from their qualified account. So some people don't like to do that calculation. I don't know how much I need to withdraw. So all these companies offers you this feature that you check the required minimum distribution and they will automatically send you a check for that much amount so that you won't be subjected to the IRS penalties. Right? For illustration purpose, let's not worry about that. Now, what I should select here, because my intention is to show the maximum income, I will go with maximum lifetime income that my client can have. So he's 50, let's say they want to income after starting 65. So I'm saying starting year 15, M is maximum means throughout their lifetime. So I will select that and then we have option to generate the reports. There is a way that they have updated the software recently. Now you can do a quick view also, which means you can see this number without even generating the illustration so that you can quickly go and make some changes. It shows you the guaranteed number, most recent 10-year numbers, all those things are here, right? So let's say we already know what we want. So we want to generate this illustration so that I can share with my client also. So now it is generating. Again, this is a client-facing illustration that you can share with them. It is very powerful tool. Again, it has a lot of information. Some of the things that you really want to explain to your clients. What this is, it's a single premium fixed index deferred annuity. Remember, we talked about deferred annuity, index with all these terms, premium. If you go back to my document here, we talked about deferred annuity, the premiums, right? All those things. Exactly, this is what it is. Single premium means client is just paying one time rollover, one time lump sum money coming in. Fixed index means the allocations will be based on a fixed index. Fixed indexes, which means your floor will be 0%. You only go on the upside of the market. And deferred annuity means you are looking for income in future, not immediately. So you are deferring it for a certain number of years. Okay, and then you can read through the other material here. It has your information also. So have it, fill it up, have it correct. And what else is here? So it shows you all the features up here, the major features, growth potential and protection, right? So these are some of the important points because you have to read it to your client. Growth that is protected from stock market risk or losses. They do not see these things everywhere else. Like my growth is protected from stock market losses. That is something cool because people are so used to of losing money. So this is something new for them. While it's possible to earn zero interest if the market declines, which means you will never earn less than zero. No matter S&P goes 50% down, 30% down, 20% down, I am going to stay at the same point. Or any interest that you earn is also locked in and cannot be lost to future downturns. So if your 100,000 grows after 1 year, it locks in and now it becomes 110,000. Now your new locked in money is $110,000. So what that means is principal plus growth is also saved and protected. Can you say with the stocks, okay, you start with 100,000 and you get to 110, 20,000. But what if market goes down? You again go back, right? Here you don't go back. Same thing that we show in our BOP presentation, the index contract. Exactly that is what is said here. Now, income guaranteed retirement paycheck. I will tell and highlight this word to my clients. Hey, read this word, guaranteed. It's not hypothetical. Once you start your income, it will be guaranteed for your life, for you and your wife if you opt for joint income. When you are ready, you can create a stream of income. Right? Where see, these are so powerful terminology that they are and it's on their brochure. I'm not writing it up. It's not in my presentation. You have some flexibility if you need to withdraw some money early. And this is another myth that a lot of time people fail to convey to their client because they haven't heard. Like I haven't heard this annuities things, 5, 6 years ago. So whatever people say, I will take it, right? So the common myth is that if you buy annuities and if you not end up using it, all the money goes away. Company keeps all the money. But that is not true for most of the annuities. So you need to tell your clients this also. You know, when you buy this plan, if you whatever money that you end up using is there, if even after taking lifetime withdrawal, your benefit base will continue to grow. The beneficiary may choose this. What this means is any money that is left over in the plan will go to your beneficiaries as a legacy, right? So you are not going to lose any money. Your beneficiary will get money. And another difference between Nationwide and Athene Agility is that in Nationwide, your benefit base is only for you, for your income. But if you pass away, your beneficiaries cannot have access to the benefit base. They can only get money from the accumulation value. In Athene, they have access to benefit base also, right? Which means beneficiary, when they get a letter from the company that this is the money that's out there, this is the accumulation value, this is the benefit base value, which one you want. So if they decide, because benefit base is much higher because there's a bonus, there's a higher crediting. So in 5 to 10 years they can withdraw. They will not get a lump sum check, but they can take out in 5 or 10 checks at benefit base. So another difference. So that's why this makes even a better plan from that. Now again, which one is better? I don't know. If client is really worried about passing on more money to their beneficiaries, definitely then this can be a good plan. But no, if they are really want more income for themselves, which is guaranteed, then nationwide is better. So I'm trying to confuse you again at the same time because you want to understand the differences clearly. Don't just, if I say, yeah, because this is better, it has benefit based distribution also. Now you are confusing. Hey, understand what your client needs. You need to explain all these things to them before they sign the application. Okay? Okay, few more minutes and we'll be done, definitely. So, and I'll have some room for questions. Or we'll explain more in detail about this. So it talks about all the things, what allocations that you pick right here, the allocation percentage, their current rate, minimum guaranteed, current participation. I'm pretty sure, we have discussed a lot about this participation rate and what is this spread and all. But if you have any question, definitely post in the WhatsApp group. One session will just do on this, what these participation and all. But my focus is to tell you something about product here. So as I mentioned, 50% bonus. So highlight this to your client. See, remember we contributed 100,000 and benefit base already got 50,000. That's your bonus. Your interest will be credited 200%. Let me explain you that in a second. So now we'll go to now this is the indexes performance, past performances and all. Again, self-explanatory. Please read this. If you don't understand, post a question and we'll cover that. Now, this is the 0% charge. Sometimes people really feel nervous about sharing this. I feel super confident about sharing this 0% because this is the game changer. This is the where you get a yes. Now, why? Because what I'm telling my client is we picked so many indexes, right? All this S&P and others. But what if none of them work? If none of the indexes is working, everything is going negative. What that tells to you, Mr. Client, what that tells to you? That tells you that market is really in a bad shape. Everything is going down the hill. Your stock portfolio, real estate, everything is in trouble. But even that happens, this is holding the fort for you. You see your accumulated value 100,000 still at 100. Benefit base got 50% bonus, 150, 150. You are not losing a dollar or a dime out of your plan, even in that situation, even in the things when the market is absolutely worse. And that also proves that there is no fees involved because the both numbers are staying same. If there is a fees, this will start to go down. This will start to go down, right? So that gives them confidence. And even in that case, if nothing is growing, nothing is happening, you still start with an income of 6,375 for rest of your life, as long as you live, right? It keeps on going and going. See, just going on forever. So this gives them a confidence. This gives them a confidence because what happens after a few years, all these numbers are zero. Just like assume this is your 401k account and after a few years you withdraw all the money and nothing left out. You still expect a check out of it? You won't, right? So, but here doesn't matter. There will be a paycheck to you every single month, right? So that's what gives them a confidence. Now, assume this is a worst case scenario, right? I don't expect that everything will go down forever. It may go down for 1 year, 2 year, but not forever. So in happy case scenarios, let's say the indexes are performing and we take an average of last 10 years and it's about 6.5%. If that happens, then how your account will grow. So these two are important columns, accumulated value and benefit base. So accumulated value earn 6.5%. So that's what you see here. 6,400 $2 added here. But you see your benefit base 50,000 added for the bonus. So that will be 150. But still you have 12,000 more. How come? Because remember that 200% credit. So 6,000 plus 6,000 is 12,000. So they added double the money in benefit base as compared to accumulated. And that goes forever. That is why in next 10, 15 years, your 100,000 will go up to 400, over 400,000. And then you start your income. It is a guaranteed income of 18,679 for rest of your life. But what if market is still performing next year? Then the gains will be added to your income. Now it's 19,000, 21,000. So any number that you achieve will be your new base for rest of your life. You never go back to 18 also. You stays there, right? Any point of time, if you are not there, if death happens, right? So let's say at age 70, let's hypothetically take an age 70. So the death benefit column says $181,000 that can go to your beneficiaries. But you see, you have $340,000 in your benefit base. What about this money? In nationwide, this doesn't apply. Now, in Athene, your beneficiaries has an option. Either they can take a one check of 181, or they can split $340,000 into 5 or 10 payments, which is mentioned here if you read this line. So that means, again, this is qualified money. So if they take all money one lump sum, there will be a lot of taxes there. So it will be a good idea for them also to withdraw in chunks so that the tax will be handled properly, right? And if you continue to live, you have a lifetime income. Even see all the numbers are zero and your income is 44,000. So your asset already depleted, but your income is still increasing. That's when we said you have an increasing income on your depleting asset. Show me one thing. Show me just one thing where you can do this in a guaranteed way. right? For rest of your life. And without doing any management, you are not managing, you're not paying anyone to management fees. It's just peace of mind, that check will be coming. So I know there are few other things that we will share, like the other rider, where in disability you can double your income, but it will be go a little than really over and over. So I will stop here and we can take 5 more minutes if you have any follow-up questions on what we just shared today, and then we'll continue next week again. Let me see who's asking. Yes, Sailesh, bhai, go ahead.
Hi Anuj, can you hear me?
Yes, I can.
Hi, thank you so much. This is really helpful. So I had two questions. One is, say, as a consumer, if I'm thinking right, and disclaimer, you have been helping me out with the annuity details and you have educated me. But the question I had is, um, if we take this hypothetical 100K
Mhm.
and we look at how much, in what year does my 100K come back, right? We see that in the cumulative withdrawals column, right? It is around age 70, so around 20 years, right? So if you look at the rule of 76 or whatever, compounding 20 years, that would 100K would actually grow to around 320K, right? Um, I understand that this is like if we outlive, and also the benefits, death benefits, but uh, is that where the advantage is only after like 20, 30 years that it starts to pay out? If I argue like 100K, I'm going to keep it. My actual amount would be 320K in 20 years, whereas here it would be just 100K for like 20 years, right?
I think I'm not sure if you're asking this thing. So if you see this again, based on six and a
Right.
half percent growth, again, we are not considering high numbers in growth. So
Right.
your 100K in 10 years will be 352, 326, right? So that is almost three times, more than three times. So,
Oh, I see. In terms of like once I start withdrawing, right?
and then
When you start withdrawing, say
when you
from
start
2040,
withdrawing
right?
within 5 years, you have withdrawn more than your 100,000. This is
Right. So that takes it like 20 years from the day I put in my 100K, right? At the age of 50, I put 100K. And when I start withdrawing at the age of 70, I get my 100K back, sort of.
But money is
Correct?
still there, right? So money is still there in the
Right. The
account. It's just
benefit,
you are
yeah.
not withdrawing the whole thing, right? You're just taking out income. So
Right.
you're not, again, I don't know if I can explain it
Yeah,
in a better way, but
let me add one thing point.
yeah.
So, Silas, there is a two things. So when the person kick off the income, the benefit based column, he's getting income based on this number, whatever the number that year he kick off. Okay, so that's how you see it. And benefit base keep getting a earning whatever the rate of return. That's why you see some of the even the money is withdrawn he got,
Mhm.
and still some interest is added. And the accumulated value is the actual real performance number. Okay, so to these two column is there is a purpose. Okay, benefit base when they want consistent income for this product. Okay, so this number has at least 200% rate of return. You see that 6.5, 12,000 he was explaining,
Right.
uh, in benefit base, right?
Correct. Correct.
The
Okay.
rate of
So,
return.
yes.
Mhm.
Go ahead, please.
Yeah, yeah. So that's the core part. Yeah,
So
I'm
basically,
done.
we
Like,
are yeah, we are waiting. This is again the benefit of outliving our savings, right? So we put in 100K, but even though it is a little late that we get the money back, but it's guaranteed for the rest of our life. Is that the benefit here?
Correct. Correct.
Okay,
And you
I
can
see.
start early also. It's not that in this illustration I design in a way that you're starting at 65.
At 65. Okay.
Correct.
That brings me to the other question, Anuj. Ideally, if I'm in my 40s versus a client, for example, if he's in his 40s and he wants to do that, do you recommend that they wait, say 55, which is at least ChatGPT tells me that that would be an ideal age. I know everyone's situation will be different, but do you recommend this in the 40s or more so in the 50s and above?
So this is again depending on the client profile, right?
Hmm.
If they are not doing good, like I have clients who have 401k money and or IRA money, but they don't know how to manage. They don't know what to do. They are losing. So it is still better to roll over into plans like these. At least they
Hmm.
know it's not going to go away and it's going to give them a guaranteed income in future, right? So if client is too much aggressive with the stock portfolio, then they can little bit grow more in next few years. So it mostly depend on the profile of the client.
I
I
see.
have clients who in 30s and they want to participate here. I said, you still have a lot of time to grow your money. Why you want to do that? And they say, no, I don't want to take chance. So, and some
Uh-huh.
people at 75 also, no, I don't want annuity because I want to control my money and I like stocks. So it's just
I
the way
see.
they
Okay.
see things.
Okay, it's client specific. Okay, thank you so much. One last question, guys. Anuj, you showed me about the single and joint option, right? And you said that in Athene, we have the flexibility that I can come back later and decide to switch from one to another. Uh, the payout, in terms of this chart, will definitely be different whether it is single or joint, right? How is that adjustment done? Is that done
So
on the yeah,
in since we are talking about Athene, in Athene,
correct? Yeah.
they will do 0.5% less. So let me show
Oh, it kicks in
you.
when I start
So
withdrawing, right? So I can.
there is some
Mhm.
payout factor percentage based on the
I see.
age. So let's say for this number, it is about 5%. They are calculating 5% of 439, for example, let's say
4.75, this one.
4.75.
Sim-
So when it is joined, they will do 0.5% less, which is 4.25.
I
But
see.
then you are covered for both. So 4.25 of this for rest of the life. And then even the surviving spouse lives longer, maybe a couple of years, then that number will be substantially higher than what you lose with 0.5%
I see. So that change is permissible uh, before the 15 years, before the payout starts, right?
before you start the
Whatever.
payout.
Oh,
Yes.
okay, okay, that makes sense. Okay, perfect. Thank you, guys. Thanks, Anuj. Thanks, Prabhakar. You answered my questions.
Okay, and Abhijit, you have question?
Yeah, hi. I have one question. So I have an annuity which before coming here I had it with Alliance. It's been 7 years, but the product is not good. And then the only stuff I was able to do is change the allocation to PIMCO during the open enrollment. Means I know if I withdraw early, there is a charge and all that. But now I cannot change the product, right? Because there are so many better products in the market. And if you do, then your cycle starts from before, like 10 years will kick in if you change, right? You cannot keep the same expiry date and change the product within the same family. Is that possible?
No. So, and this is going to be like this. Like, let's say today you like this product and you say, this is so good. But 10 years down the line, you will see another product which may be optimized even better. So, like, we buy this phone, few years ago I had this iPhone 5. Now it's 15, 16, 17, I don't know. So it's always like that. There will be better versions. So at the time when you are making that decision, is that fulfilling your needs? If that's so, then it's a good product at the time. But once you are out of those surrender period, once you are, not much charges, at that time you can always consider looking at what if I change it to a new product without losing anything. or if you are losing something, whether the new change is really better so that you can take that much hit. So looking at what you
Okay.
have and how much you lose versus
Roll
the
it over.
benefits.
Can you roll it over?
Yeah, see,
Uh,
when you roll over, it's still there will be surrender charges if it is within surrender period,
Oh,
just like
Yeah.
any other plans.
yeah.
And
And
yes.
I had one more question. Uh, okay, should I go ahead?
Yeah.
yes,
So we are doing IUL, and we wanted to know either AIG is better or North America, because North America is provided guaranteed income also. So we are debating now which company should we go with, AIG or North America.
both are actually equally good, and we both offer, both companies. So I would say it's not easy to say you go with North American or AIG. It just run the same numbers with both companies and compare side by side with both income rider option selected. AIG also offers the income rider, North America also, and then see. And I think because you're not licensed, so it will be hard for you. So maybe Payal or
Okay.
Saurabh can run side by side and then show you.
Okay.
Okay. But
Because
as far as the
numbers will
company
change.
goes,
Oh, both are good companies. Both are 100 plus year
good
old company.
companies.
Oh, super, super good. No doubt about it.
Okay.
Okay.
Thank you.
Thank you.
The,
Yeah. Prabhakar had something to say. I don't know.
Yeah, Prabhakar, go ahead if you have anything to add.
no, I think that's uh, for company wise. I think we need to do some like because a lot of question is coming like how can we convince the client this company is good, that company is not good. So five things. So one of the trainings will do how can we assure the company we represent is very good. Number one, top five, those things. There are 4 5 factors. We'll cover those things in one of the training, Abhijit. Okay. If you are confident enough now, then only you can pitch in the those companies' product to the client, and client will be agree and move on.
I
Okay.
think they're looking for themselves only.
Yeah,
That's
for
what.
ourselves.
Yeah.
Yeah. Yeah.
Thank you.
So
Thank you. Yeah.
we'll definitely run and compare it parallel. Okay, and one last question from Relish.
Yeah, so this annuity that you showed, Anup, it is for just a client who is looking forward to the income increasing in the retirement, right? Because
Mhm.
there is no money left for the legacy for the family. At the end of like 80, 85, I think the balance is zero now, so that like they are not going to leave anything behind for their family.
So from your 100,000, you withdraw 419,
Okay.
and then the account goes to zero.
Okay. So that's what just my question was like that. Like that is this is not a legacy product. So we have
Oh,
different
it is
products.
a legacy. No. What do you mean by legacy?
Legacy for the family.
Yeah, so if client pass away at 73, there is a legacy for family, $256,000.
Yeah, but if he doesn't pass away, if he lives long, then there is no legacy.
So that applies to everything in life, right? In 401k, in real estate, in stocks. If you live till 100 and you used everything,
There is nothing left.
yeah, means yeah, it's hard to say what
Okay.
is actual legacy.
Yeah.
So that's like the
Right.
point is when he's withdrawing like 50,000, he has to buy the life insurance policy for the legacy, I guess.
Even in life insurance also, I don't know, at some point of time you might run out of money.
Okay.
So it depends, but this is a perfect way to set aside some money where you know for sure that you are never going to run out of money.
Hmm.
And if anything left behind goes to the beneficiary, even account values are zero, I am not running out of income.
Okay.
Unlike my stocks, my 401k, my IRA, where once money is out, I am out
Okay. No, this
without
is
the stress of
So,
managing.
one point here add Anuj. So you see the at the age of 77, if the person is alive, let's say joint, whoever is a survivor, they keep getting a money, the column you are saying, even the money is depleted, and in a death benefit column is zero. If both the person pass away, nothing will pass to the beneficiary, right?
Mm-hmm.
Right, Anup? Death benefit column becomes zero at the age of 78.
Yes.
You, you got it, really?
Yes, I got it.
The legacy, when you are talking about,
Mhm.
you are talking about whatever that benefit that goes to the beneficiary, right?
Yes.
This income, when the person is alive, both wife, husband, they are taking jointly. As long as they are alive, one of them keep getting this money, left withdrawal column.
Okay.
If at the age of 90, both pass away, nothing, zero value in that benefit. It goes to nothing. Because annuity product is kind of pension like a social security. If both is pass away, then why the social security give money giving to the children, right? Treat annuity like that way. It's kind of pension,
Okay.
right?
Just
And
like
obviously, early age, if pass away, if they have a death benefit, let's say 74, this 82,000 money goes to beneficiary. That's all. Uh, is that okay? And you want to add
Yeah,
something?
no, that's exactly right.
now,
Um,
second
yeah,
question I had it in this scenario. This person is like a 50 years old, putting $100,000. And they're like, if